This past Thursday and Friday, a couple of very interesting days on Wall Street. A near 1,000-point drop that happened in minutes. Couple that with extreme volatility, with investor fear, and then that leads us to today's topic and this Money Monday, the lost art of investing. But first off, talk about some big numbers that have come across here this morning. What's going on out there?
Yeah, the futures markets are up almost 400 points this morning. I'm not sure I've ever seen that in my investing career. And what happened is the Euro countries, the Eurozone, put together a significant package that nobody thought they could get done. We have enough trouble in this country, and we're one country. You have a dozen countries over there, and they had to all figure this out together. And I'll be darned, they did. And it seems to be a pretty good plan.
Especially with Greece in the mix here. That's got to be a very difficult problem.
Well, Greece is what caused a lot of this. And you see the cultural differences. Those countries didn't want to help each other. The people in Greece retire, I think they said, when they're 50 years old. Other countries are working later, and they're like, why would we want to fund their retirement?
Right.
So very interesting.
Got it. Okay. Back to the art of investing here. Investors are actually traders and not investors at all. Tell me a little bit about the semantics of this.
Yeah, you got to decide what you want to do. And I broke investing down into three different areas. We have speculators, we have traders, and we have investors.
All right.
Speculators are people that are trying to achieve significantly above average returns in exchange for significant risk, even the risk of losing all their money. That's gambling. That's not something I recommend. It's not something many people do. Now there's trading and investing. Traders are people that usually are buying stocks or equities of some type. They're holding it for a day to maybe 90 days, and then they're watching the markets every single day. Fluctuations mean everything, and they really don't care if it's a great company or bad company. They're more concerned about what are the odds of it going up or down, so they can make money on either side.
Okay.
Well, but most of us are investors, but we've been trained by the CNBCs of the world to think like we're traders. Investors look at companies and fundamentals and what looks good over the next 1, 2, or 3 years. Not that buy and hold works perfectly or should be part of a portfolio, but the day-to-day fluctuations of the market shouldn't really bother an investor because they're looking much further than that.
Now, when Jim Cramer's running around with his sleeves rolled up and barking at the camera and hitting the red button and stuff like that, a lot of people tend to freak out on that.
That's all trading. That CNBC set up for trading to see what the market's doing minute by minute, second by second. And by the way, the returns of investors and traders aren't significantly different. It's just different ways of getting to the same place. And some people can use both of them to really have a cool approach. But most of us don't have the time, temperament, or training to be traders. Investors is the way to go.
And no matter what you do, you got to do your research. That's the only way to get through any of that.
Do your research or hire somebody that can do it for you.
All right. Kevin Meyerhoff, it is a Money Monday. Thank you very much for